Okay, good morning, everybody, and welcome to the latest Urban Living webinar. Today, we are going to be discussing how to kickstart investment in the living sector. My name's George Sell. I'm editor of Urban Living News, and we are an online B2B platform for the living, hospitality, and flexible workspace sectors. We have got a terrific panel today to get stuck into this topic. I'm going to ask them all to introduce themselves quickly, and we'll go from left to right as we see them on the screen. So first up, I'd like to say welcome to you, Daniel.
Thank you. Hi, my name is Daniel Harris. I only very recently joined Fusion about 4 weeks ago as CIO. Previously, I have been on the investment side of this industry, working in private equity. Spent the last 7 years heading up K International's European Equity Investments platform. Previous to that, I was at Tristan Capital Partners. So I've joined Fusion, a group that I've known and worked with for the last few years. To help on the next phase of their growth. We currently have developed about 6,000 beds. We have about 3,000 under construction, and we have a secured PBSA pipeline of about 8,500 beds in the UK. So exciting times ahead.
Great stuff. Thank you, Daniel. Nada, good morning to you.
Oh, good morning, George. Good to see you this morning. Yeah, my name is Nada Jarnaz. I'm a director in the development finance team at Maslow Capital. Maslow specializes, we've been around 15 years and we do development finance for the living sector. So that covers a lot of PBSA, build to sell, build to rent, co-living, retirement living, really here to try and support the housing needs in the UK and now expanding across to Europe. So we're operating on the same model in Ireland, Spain, Portugal, and Italy. And we do a wide variety of size of schemes, so anything from 10 million up to 300 million. So narrow but broad. Good to be here.
Thank you, Nada. Ami, welcome to you.
Oh, you're on mute, Ami.
You're on mute, Ami.
Can you hear me now?
Yes.
Yeah, sorry. Good morning, everyone. My name is Ami Kotecha. I'm co-founder and group president at Amro Partners. We are a specialist living sector investor. We are pan-European, and we're focused on multifamily, which is built to rent in the UK, and co-living and student housing in Europe. We have a pipeline of circa 2.5 billion across these sectors, with asset sizes ranging from 250 units right up to 700 units in our larger assets. Since our inception, we've had a very strong thematic focus on this alternative investment asset class, primarily because, as we all know, it's got a large and underlying demand driver and a great sort of stable potential for growth. And equally, there's always been a supply side shortfall in any one of these categories of housing. We've been equally focused in our specialisms around sustainability and data, which we take a very strong embedded approach to delivering. So we're very focused on delivering smart and green buildings, and we see them as very key value drivers for us. And in my individual capacity, I've been in leadership roles across several associations and industry organizations where I've helped with the digitalization of processes and bringing the industry into the realms of understanding prop tech and innovation as key capacity building drivers for our sector. Thanks, and great to be here.
Thank you, Ami. And finally, Richard, good morning to you.
Yeah, thanks, George, and good morning, everybody. I'm Richard Brenner, and after sort of 14 years across sort of PBSA, I went and set up my own consultancy last year, so think Resi Consultancy. I specialise in operational performance and driving operational sort of value through assets. That's my background. Led the European sort of team for a pan-European sort of portfolio, about 20,000 beds, and through the consultancy, bring a lens of that performance enhancement through people, so getting the right leadership and the right leadership behaviours within organisations. Basic performance, so is that operating platform efficient and effective, and then leveraging technology in the right way to again drive operational performance. So yeah, delighted to be here, and speak to you shortly.
Thank you, Richard. Thanks, everyone. Okay, we're going to see a couple of context slides before we start the conversation. Oh, beg your pardon. I probably ought to do the housekeeping first. So the webinar is going to last an hour. We're going to have around 45 to 50-minute conversation with our panelists. Would love to make it as interactive as we can. So if you have any questions, please do submit them using the Q&A or the chat functions in Zoom. We'll either answer them there or then, or we'll save a bit of time at the end of the session. Everyone who is registered for the webinar will receive an email in the next few days with a link to a recording. Okay. So I just wanted to show a couple of context slides just to give the conversation a bit of background. These are all stories that we've run on Urban Living News in the last 2 or 3 months, just to show that things are happening. Investment activity is slowly increasing. We're starting to see interest rates come down. So I think the sector as a whole is at a really interesting point, and I do think next year is going to be a bit of a barnstormer for the sector. I hope I'm right. We'll find out if our panelists agree with me shortly. But here are a few stories just to kind of show some of the types of investment activity that are going on. So top left, we're starting to see living sector assets refinance now, which is important. There are quite a lot of fears out there about potentially stranded assets, but we've seen quite a few refinancing deals recently. We're seeing some big institutional powerhouses teaming up to get involved in the sector, particularly build to rent. We're seeing portfolio sales now, particularly in PBSA. We've seen quite a few portfolio sales, chunky ones in the last couple of months. And most of the consultants you will speak to, such as the CBRE in the bottom left story, are predicting a real uptick in investment activity in the next year or so. On the next slide, we've got some similar stories. A lot of investment going into UK build to rent, and it seems that with every new report coming out, the single family sector is taking up a bigger chunk of that investment. That's one area that is really hot at the moment. We're seeing investors going pan-European, as Ami mentioned earlier. Her company has partnered with Invesco to buy a couple of PBSA sites in Spain. And there is development finance out there to be had. So that the bottom right story is a recent one for a developer and operator securing development finance for a student scheme. And we'll find out more about that development finance piece from Nada shortly. So let's get stuck in. Let's start by asking, what are the current investment priorities and risk appetites of investors and lenders in the living sector? So Ami, I want to start with you on the investor side, and then Nada, I'll come to you to talk about the lending side. So yeah, Ami, where are we at? What's sentiment like at the moment? You're on mute, Ami.
Sorry. It's really nice that you set the context there, George. And we've seen that investment sentiment has really started to get very positive in the last few months. I think the change of government has been super positive in that it's given us some kind of certainty and stability, which was really lacking for any kind of long-term investment. But we've got to remember that we've come through a very, very tight market condition. So it is going to take, I mean, investors are taking their time to actually address their reallocation, reallocations and their priorities. We've seen that there's been a real kind of pent-up demand to come into beds, definitely been the favorite of all sectors, but there's been a need to unwind out of office allocations and rebalance portfolios that we're all still talking about quite a lot. Obviously, where investor priorities would be to go out and buy good quality operational stock, but as we know, there is a real lack of that quality operational grade A, institutional grade stock. And so money has started to come back into development of new assets. You've shown us a lot of those announcements that have recently been made. And I think the investment priority now is really to start looking at this again as a value add pool. Core plus capital has been missing and was missing for a long time, because obviously it's looking for alpha vis-a-vis risk-free rates has been hard. But investors who are now starting to come in are coming in with a priority to come in for the long term. And we see that same that same institutional activity starting to happen that we'd actually got very used to before the current tightening, the recent tightening. So that's all looking very positive. On the micro side, there is, compared to even 2023, we've seen even more pent-up demand for rental homes, obviously because of where mortgage pricing has gone. And that's becoming a big story. It was with house builders where they were really willing to sell at 10 and 15% discount to single family investors because they saw that kind of fallout of demand for new homes. If that obviously starts to come back, we might see that single family may have reached a certain level of saturation. Those are kind of bite-sized investments that are hard to replicate, often in second-tier cities or less kind of attractive long-term locations. So we may find that actually BTR becomes the sweet spot again in not long to go. That's my overall view on investor priorities.
Great, thank you, Ami. And Nada, how about from a lender's perspective?
Yeah, I mean, from a lender's perspective, the lending market is still very strong and there's still a lot of appetite to lend, but the risk appetite hasn't changed, right? So, we're sort of lending, we're not going further up the risk curve. But what is happening in the development market in particular is that costs continue to go up, and we had an escalation of costs due to inflation and, supply chain issues. But now we have got sort of integrated costs associated with planning and upfront costs of planning, building safety, fire safety, all that kind of stuff. So it just means that it's much harder for investors and developers to make schemes viable. And so, within the ecosystem as a whole, more creative solutions need to be brought forward to sort of plug the equity gap that's needed to make schemes viable. And sort of that dovetails with what Ami was saying, is that the market has been quite difficult over the last 18 months. Investments that haven't come in have meant that there hasn't been new equity going out. And so going forward, there's optimism that as investor appetite improves, as rates come down and there is political stability, that's going to get things moving a bit more. But I would say that there's a lot of debt out there, but just probably less products to sort of lend against just because of the market conditions.
Yeah, thank you, Nada. Daniel, we've seen a couple of rate cuts recently, and I think the general expectation is that there are more to come. Do you think there are sizable numbers of investors and developers kind of still sitting on the sidelines waiting for a couple more cuts before they plow in?
I don't really think people. I think people are investing now based on where they think the future rate curve is going to be. So I don't think anyone's really waiting anymore. They were waiting in 23 because 23 was filled with the next rate cuts coming next month, and then it got delayed. So since September, rate cuts are coming. I don't really think this government has particularly helped with its relatively inflationary budget, because that's obviously pushed race expectations up again, but not much, but you're still expecting rates to go down. So I think people are sitting on the sidelines, and I agree with Nada in many ways. Finding development financing is not really the challenge for the market today. It's finding the equity that wants to take the development risk. We're a developer, and we have and we're prepared to take that risk. But as we grow, and as I said, as we've got a very, very large pipeline of assets, finding equity to come and take some of that higher risk appetite is always challenging. There's lots of people out there who are very interested in buying income. For whatever reason they want to invest in buying income, to get a secure yield, and think there's growth in the market, etc., etc. But without developing the products, there's not much income assets to invest in, particularly today, where there is a lot of first and second generation stock that's relatively out of date. So we develop good quality, large scale PBSA, and we need to develop that to provide the assets for people to buy going forward. And I think that the challenge at the moment is actually finding the equity that wants to share in that part of the risk profile, rather than finding the debt. I think the debt is it's not actually that difficult to find at the moment. And actually what you're seeing now is because equity, finding investors that want to take that development equity is a little bit more challenging, and because rates have come down, there is better loan-to-cost financing available. Therefore, developers such as us sort of have a choice in some ways now, which we didn't have 12 months ago, which is we can actually develop these assets by ourselves because there is more attractive debt financing available. So it puts developers like us in a pretty interesting position where we can have a conversation about whether we want to take on, we want to develop ourselves, which obviously has a certain risk issue, because the debt markets are there, or we want to bring in equity. And if we can't find the equity deal we want, then the debt markets present a very, very interesting opportunity to basically build that income portfolio off our own balance sheet. So I think the market's quite interesting. I think for us as a developer, we sit in a pretty interesting spot of the market now.
Yeah. Thank you, Daniel. Ami, how has the interest rate environment affected your development strategy over the last couple of years, and how will that potentially change going forward? I mean, I think most people are agreed that we're not going to go back to anything like the low rates that we had pre-COVID, and that around about the 4% mark is potentially going to be the norm for quite a long time. So how does that affect your development strategy?
Absolutely, and I agree with everything that Nada and Daniel have said before. That equity, the lack of the supply of equity has definitely had an impact on our strategy. And we are, as you know, a vertically integrated investor, developer, operator. So it's obviously critical for us to have debt finance at a reasonable loan to value and loan to cost. In terms of, I mean, the way I mean, if you look at what's available in terms of capital finance for investing in the sector, I mean, essentially forward commits were very difficult for a long time recently, because the developers found it very hard to go out and commit to entire development cash flow themselves, and forward funding also was limited because of the lack of alpha relative to the risk-free rate, and that's also been in shortage. So as far as our investment strategy is concerned, we've been very lucky that we've had extremely good long-term institutional capital partners come on board as JV partners. And that's been completely transformational, because there is a much better alignment of return and risk, and upward and upside downside potential. And also we've been able to really focus on total return, which is what I think this sector is all about. I think the institutionalization of the living sector is happening in a way in the UK, and it's following patterns seen elsewhere, where investors are much more focused on total return, and hopefully that means holding for a longer term, and seeing the rental growth value come through. And I think there's a ton of potential still left in that respect. So our investment strategy has been very focused around good quality JV partnerships.
Thanks, Ami. Daniel, there's a lot of global capital out there looking for a home, but we're in a pretty volatile geopolitical environment at the moment. There's a lot going on around the world, a lot of it not very good. How is that influencing investment in the living sector in the UK and Europe?
Look, I think that capital is still very focused on two things: beds and sheds. Obviously, we're not talking about sheds here. But if you think about, like, if you go back to 2016, 70% of the investment market was office and retail, right? 70% of the market is no longer office and retail. And so if you think about those sectors in themselves, they were very, very large, dominant parts of the market, right? So beds and sheds, and particularly beds, is really it's really just starting, right? People are, and as a result, there is a significant desire for capital to be in those sectors. There's no investment manager today that doesn't have a beds and sheds strategy. The problem is it's very, very hard to marry the capital with the risk profile they're wanting. Right. As I said before, some capital wants incomes, less wants to take development risk. And because living, in a way, the real opportunity in the living sector today is the development of these new products, whether those are PBSA, whether they are co-living, whether they are BTR, whether they are senior living. There's not a mass amount of those products that exist. If you want to go and buy offices, there's lots and lots of offices that you can go and buy. So capital wants to get into the sector, but it has to work out how it wants to get into the sector. And, you know, I think ultimately it's about partnering with good quality operators in whatever geography that you want to be in, and finding those opportunities that capital wants to go and do. I mean, as I said, everyone wants to buy income, but there's just not that much of the actual good quality income available, which I suppose a lot of us on the panel here are trying to hopefully provide that product in the future. But global capital, if it wants to get into this sector, in my view, needs to take a slightly different view around development. Otherwise, there's not going to be that products to be developed for people, for investors to buy in a few years.
Thank you, Daniel. Let's talk a little bit about the specific verticals within the living sector and the challenges and opportunities around developing in those markets. Richard, let's bring you in. You have a PBSA background, so can you kind of give us a snapshot of where the PBSA sector is at and how you think that might evolve, and what the main challenges and opportunities are in that market at the moment?
Yeah, sure, George. George, thank you. It's not new on anybody, the fundamental supply demand. So that's stating the obvious. I think over the last few months, the challenge is around getting the right product. Affordability is pretty frequent on people's agendas in terms of being able to tackle that supply. So whilst we've got this, this material sort of undersupply, that's quite a challenge. The opportunity, I think, is probably a couple of things. And I've seen, heard, and listened to these over the last sort of couple of weeks. We're not going to tackle that affordability piece individually. And I think there's opportunity for us as a sector to be able to address that affordability from capital all the way through to who we're working with, planning, legislation, etc. So that opportunity and that fundamental 600,000 beds supply, we've got a really great chance of being able to deliver that as a collective. So I think that's a real sort of piece there. I think from an operational sense, and having been in operations for the last sort of 14 years, general real estate, but particularly in PBSA, I think a real opportunity to get slicker is around our use of technology. And that's from the very outset from looking at design, those opportunities, feasibilities, all the way through the spectrum of how efficiently are we running our sort of businesses. And through that, what you're actually doing as a consequence is partly attacking and addressing some affordability, because you're doing that more efficiently. You're taking cost out of that full stream from top to end. So it's buoyant, George. It will remain sort of buoyant. We've just got to look at things differently and work more collaboratively, with my view.
Thanks, Richard. Daniel, is there a danger that PBSA developers and operators are pricing themselves out of the market in some instances? I mean, I had a look around a central London PBSA asset fairly recently, and the rents there were considerably higher than a much better amenitized build-to-rent building 2 or 3 miles further out from the centre. Is there a danger that is the golden goose in danger, do you think?
Look, there is no question people need to focus on the affordability issue within PBSA. What you are actually seeing in London at the moment is you are seeing an abundance of new projects coming through that people are trying to finance, look at, that are focused much more around the affordable nature of London. And affordable is a relative term because it's also relatively expensive. But if you're going to be in zone 1 at £700-800 a week, or you can be in zone 2, zone 3 at £400 a week. You know, that product at £400 a week looks very affordable. No, it's another interpretation whether £400 is affordable. But I think there is definitely a view around affordability, and it's definitely a focus of the market going forward. Look, and I agree with you. I think zone 1, if you want to be in zone 1, there is a market for someone that wants to pay that, right? And why do you want to be in a PBSA buildings? Because you actually want to be surrounded by people doing effectively or similar. Some people doing the similar thing as you, rather than opposed to BTR building. But PBSA does have to recognise that particularly when you're in a capital city, such as London, where you have a more diverse group of tenants, right? Where if you're in a Russell Group university, you know, outside of London, I think I don't really see BTR competing with PBSA in that respect, because, you know, the city size doesn't really allow for it. But I definitely think in London, look, my view is people would still prefer, if you're a student, to be in PBSA, but it does need to, they do need to look at those BTR comparable rents. There's no question about that.
Yeah, thank you, Daniel. Co-living is a market that really interests me, and I think it's got great potential. It's obviously fairly early in the journey, and there are still quite a lot of issues around understanding and, well, misunderstanding. There's a lot of misunderstanding about what the model actually is. Ami, you guys are getting involved in co-living. What are your thoughts about the sector as a whole, and how do you integrate that with your build to rent strategy? Do you include both asset classes in the same buildings, or are they separate?
Yeah, that's an interesting one, George. Co-living is definitely, you know, enjoying a kind of a second version 2.0 revival, I'd say. Version 1.0 having not met many investor expectations as it was, you know, estimated. And I think we are really keen on the sector as filling a real gap. I mean, if you look at the trends, you know, the underlying trends we were talking about earlier in terms of who actually lives there, you have a growing migration. I mean, we have a net migration inflow into the UK right now, which actually lends itself very well to co-living. We also have an affordability issue in terms of, you know, young professionals wanting to actually come into work 2 or 3 times a week to actually grow themselves on the career ladder, and still can't afford to live in accommodation that is larger than what co-living affords. It also has a really nice cash flow component where people, young professionals, and even older people, I mean, they can plan their cash flow so that they're not really, you know, it's like an all-in rent that they pay, which is really attractive. We found that, I mean, obviously, we don't think it's going to be anywhere close to the size of the build-to-rent sector, but there's a real spot for it in the spectrum, if you like, of housing subsectors, and I think that's here to stay because it's actually meeting a real need. I mean, if you look at the leasing velocity of anything that's been developed as a sort of version 2.0 asset, and there are a number in London. London is especially attractive for co-living. It's phenomenal. I mean, you know, what the rate at which these product, you know, and this product and this asset class is leasing up is really, really interesting to see. And there are wait lists. I mean, whichever development you go to today and ask, you know, there are huge waiting lists. So there is, I mean, it's meeting a critical need of potentially a migrant population or a transient population trying out, you know, a new job in a city, wanting to move in, you know, get that social environment sort of ready-made and available, and easy. All the convenience factors related to co-living are really, really important. So I think if we continue to develop the product along those lines, we will see a real interest and long-term investment potential in the sector. But we've got to be really careful about what happened the first time round, and not build product that is unviable in the long term.
Yeah, thank you. I mean, Richard,
Yeah.
did you want to come in on that point?
Yeah, just a real brief one. I think I've spent a bit of time in sort of co-live over the last sort of 3 or 4 months, spent a bit of time in sort of Europe, looking at sort of what they're doing. I think it reminds me of sort of PBSA 15, 20, probably plus years ago, whereas, you know, a little more entrepreneurial. And the bit I really like, and it's picking up on your points of Ami, in terms of getting the right product. What they're doing is actually a lot of experimentation to really hone in on what is appealing about that sort of asset sort of class. What the sort of customers really want when they're sort of making those sort of choices. And I think that test and learn pace is actually quite exciting, which I think can be filtered through to the wider sort of living sectors. But I think it's a really exciting, growing sort of prospect where it is able to be a bit more agile than probably some of those more sort of stuck in the ways a little bit from a PBSA. We sort of cookie cutter approach already. So yeah, exciting times I think in there. I want to watch.
I guess if we look at co-living version 2.0 in terms of institutional co-living, which is where I think we're going to see by far the most growth, I guess the main differentiators are slightly bigger unit sizes. I think all units are likely to be self-contained. I don't think units without some kind of cooking facilities are and bathrooms are a goer now. And I guess slightly less amenitized. That seems to be the way forward. Daniel, when we were speaking before the call, you mentioned that Fusion are looking to spread their wings into other living sector asset classes. Is co-living one of those? And if so, what would be the attraction?
Yeah, I mean, we are definitely looking at co-living. One of our sites on our pipeline has a significant co-living element, and it's definitely part of the market we are looking to expand in. I think you need at the moment to be relatively careful about which cities in the UK you're going for. It is still at the moment a relatively high priced product, so it needs to be in those more affluent cities. I think you've got to be careful of residential developments just being now classed as co-living and in an environment that really can't take the quality of the product. If you look at it in a simple way, and the reason we're interested in it is you look at students, it is just an extension of the student product in some way. You're providing good living accommodation, bedrooms, etc., which are bigger than PBSA, and you're providing good quality amenities, generally more square meters per bed than you are providing under the PBSA product. So it really is just an extension for us to be doing, call it an adult. I look at co-living and say it's more of an adult PBSA type product. I know that's not a great description, but it's effectively an extension of that, right? But you just need to be, whereas PBSA is needed in every city where there is a university, I think co-living, you need to be relatively more precise on where you are looking to invest in. But it's definitely a sector that we're focused on. And I said we're starting to do that with some of our pipeline assets. I think where it works really well is where you can do PBSA and co-living together in the same area, right? Where you have one block that's PBSA and one block that's co-living in the cities that can stand that. And I think there's a few places that can do that, and that would work very well as a product, and would also provide for investors diversification of income and risk when you come to sell it. So I think overall, I think having that sort of mix of the two, I think is a very, very strong offering.
Yeah, thanks, Daniel. Ami, did you want to come in on that point?
Sorry, yeah, just the additional point that I was going to make is that comparing it to version 1.2, again, just to your point, the product quality has such a large bearing on profitability of co-living. Of course, I mean, it's on a much softer yield than BTR, which makes it so much more attractive as well. And the capital investment is much smaller because these tend to be sort of smaller assets. But on the product side, it's really, really quite interesting to see how churn has reduced, and you've seen lease lengths extending from what they were estimated to be around 3 and 6 months to more like 9 and 12 months. So that in itself is real proof that the product is working and is serving a need. And I think that's interesting. And also the fact that investors were really attracted, we find, are the ones where this product type or style is very accessible and available in their own countries, in their own home markets, often called micro living. So yeah, there are some high conviction investors who are specifically interested in co-living, who are coming in specifically for that.
Thanks,
interesting.
Nada, as I mentioned earlier, although we are all co-living enthusiasts, it does have its doubters, and there are quite a lot of people who don't fully understand it. Does that make lending to the co-living sector difficult?
Well, I don't know about other lenders, but we're very supportive of co-living. But obviously, as to what Daniel was alluding to, relative to the market dynamics. So, in a densely populated city, London is an obvious example. Co-living works really well for people who want to be central, and they know that, you will pay more but get slightly less space but more amenities, but you're well located and the time that you save makes it worthwhile. It's a natural progression for those students who have, I mean, you've been around these PBSA assets. They're so luxurious compared to the student accommodation that we used to live in. That was really just like four bare walls and a bed. You've got this next generation coming through who are just used to that high quality PBSA asset. And as Daniel said, it's a natural evolution to step them across into co-living, especially as we have a population that is more accustomed to having sort of a rental product throughout their life cycle, and perhaps less focused on owning their home, right? So we like co-living and supportive of it, but geography matters and demographic matters. So there are some locations where it can work, catering to a specific need, for example, a hospital that requires accommodation for their staff who need close proximity, and it makes sense, perhaps government employees, that kind of thing. But you've got to be quite careful. You alluded to the fact about, rents, PBSA rents being so high. And if you're in a location where you've got a student competing with co-living, it's got to be a location where your student population is more or less international. And I'd say the international students like the PBSA assets. They feel very safe with it. There's also a whole agency network that sits behind that fills up your student assets. But if you're in a location that has mostly, say, UK local students, then you don't necessarily want them. From an investor presentation point of view, you don't want to have to convince your investors that your co-living asset is definitely not going to be filled with students, right? You've got to have very clear demand that falls outside of the student population. What I would say in terms of challenges, we can get our heads around the numbers and the product set, no problem, and sponsor quality and build quality, all of that. But on the planning side, it's tricky because planners don't understand it. I think that it's going to go through another makeover. Ami talked about micro living. Micro living is not sexy, right? Who wants to live in micro living? So it's kind of rebranded to co-living. But I think even co-living still quite difficult to explain to planners. And so a lot of developers are struggling to get it through the planning stage. And where planners struggle is that the unit sizes are so small, they're always looking at the alternative. And it's like, oh, well, if this doesn't work, could we break it up and sell it as individual? And you can't, because the unit sizes are small on the basis that you've got greater amenities around the rest of the block, and then you've got sort of the management aspect. So I think there is an education piece that needs to be done on the planning stage. Unfortunately, as with everything else, the burden of that falls onto the developers to build those relationships with local authorities, explain to them what the product is, the demand. Yeah, and once you do all that, and it's quite a long road, we think it's a really good product in the right location.
I was
Sorry, that's a
talking.
bit of a long answer.
No. I mean, to pick up on that, I was talking to a developer earlier in the week who has recently secured a planning consent for a co-living development in Leeds. It took them 3 years to get planning. They had to go to appeal. And while
I
it was
just jump in for a second there on that, because I think
Yeah.
that's an important point that Nada's making, right? So the reason it works quite well doing it linked with PBSA is primarily for your downside, right? I agree with you, it may go through another couple of iterations, but what you're finding is that, I'm making the numbers up, if you've got 300 units PBSA and 100 units of co-living, and you think the co-living rents will be higher because there's slightly bigger rooms, slightly more amenities, and that market doesn't quite work, as long as your location is good enough, you will still be able to let those to students as maybe high quality type rooms, right? So you still have that flexibility. And I think at the moment, as that co-living sector emerges and it finds its feet, investors and developers such as ourselves need to have that relative de-risking in it. Going out and putting a 400, 500 bed co-living scheme somewhere with no effective alternative is much riskier, right? So I like actually developing it as part of a larger scheme. And I think that helps people come to terms with what that sector is going to be and how it's going to develop over the next few years.
And Daniel, sorry, just on that sort of point as well, I think a really key point that I've seen and heard from PBSA point of view, looking at that market, it's the total living market within a particular sort of city. So who falls into that PBSA, potential build to rent, the sort of co-live, because there is that transient. I think somebody mentioned earlier about who's living in what sort of property. It's about it's the segmentation of that market. Some of that is students, some of it is young professionals, etc. So as we're building rooms, there is that transient movement, obviously student upwards, but they live. So really knowing those numbers, etc., and then be able to model that from a rental point of view, etc., I think is really key. So looking at market living, I think is critical as we move into a more supply demand living rather than the segments.
I would just add I would like to add one more point to that. Is in London it can be quite difficult to get planning for a student. Co-living is sort of that's softening a little bit, and one of the reasons is that this sort of optics around students and student behavior, and you've also got the similar optics with co-living, and do people want to take up units in a co-living scheme, or are they going to be sharing accommodation with students? But I think we as a society are graduating and moving where the student population is, especially the student population that is living in that kind of high-end accommodation, they seem to be in the gym, walking their dogs, and it's not the same that, and it's not the topic of this conversation, but if you look in the hospitality sector, bars and restaurants, and that end is sort of struggling because they all just sort of like hanging out at home watching Netflix and doing, just hanging out with their friends. So there's that dynamic shift in the behavior of a student population sort of helps support the PBSA co-living conversation.
Interesting point. And actually hospitality leads nicely into the next topic, actually, because I want to talk about what's happening in build to rent and how that's evolving. At the very high end, we saw an interesting story last week. Vita Group have sort of rebranded their high-end Manchester product to an all-inclusive one, which is traditionally associated with student and perhaps co-living, but they're including all the utilities, Wi-Fi, cleaning and so on in the rent, with access to a lot of other services as well, and they're billing it as more of a hospitality product than a traditional residential product. But this is people's prime, their first residence. Ami, what do you think this is something that's going to take off at the top end of the market? Because this is the people who are living here are highly paid professionals who can afford to own properties, possibly multiple properties, but they choose to rent for the convenience and the breadth of the offer. Is that something you see taking off?
Well, I'd sort of define taking off quite narrowly there. I think I think the big chunk of build to rent is going to have to be one that answers the affordability issues pretty well and nails that over the long term. And I think most investors would be quite concerned if they put all their eggs into a basket, which is about high end. I'm sure there's some potential for that product as well, as we've seen that this asset class keeps evolving and the product and quality and services keep evolving, and people are trying more and more to differentiate their product from others. I mean, the only other big scheme that does all inclusive, and that has been for a very long time, is the Quintain one in Wembley. And the real reason behind that is because they had started out with a centralized energy system, which actually in so many ways lent itself to all bills inclusive, rather than splitting them out, because in fact they had to supply all the households, all the built to rent houses from their central energy management system. And it was just an operational efficiency question that led them to then thinking, well, why don't we do this as an all inclusive? So if there is an underlying design-led approach there that drives that decision, I think that's fair. Although of course the economics of that have to be evaluated on their own standing. But I'm not certain that it is something, especially in regional cities, that will stand the test of time over large stocks. My view is that BTR is there to really fill a gap in housing overall, and the 370,000 houses that the government wants to see built every year. I think BTR has to come in and step in and start taking more and more out of that chunk away from homes for sale. And homes for sale, I still see, and less so BTL now, as the main competition space for BTR, really. And that's very much a mix of affordability, really, that we're talking about.
Do you think in that case that the bulk of build-to-rent product now will be less amenitized than it has been in the past, so it's more accessible, more affordable?
I think there's certainly a need for affordability to be put at the forefront and delivered in the right way. And we, in London especially, I mean, there's no way you can get away from it. Frankly, you've got to do it. You've got to deliver. And we don't do anything under 35% in any of our schemes as a starting kind of point. But I think that if we are looking for long-term rental growth potential, I mean, it's a really good way to make sure that we can stabilize the asset quickly. So we see the full benefit of having a large affordable element. It doesn't necessarily mean less amenitizing. It just means really good data on what we're doing and how we're amenitizing. And that's really, really important. So, I mean, coming back to a point made earlier by Richard, I think operational efficiency is really critical to driving the long-term value of BTR. So, and delivering affordability in that sense, not just in the sense of what's affordable and what's private market rent. I think everybody will probably agree that we've come through a high inflation period, and NOIs have been properly tested in our sector. I mean, we're always talking about very thin margins in the sector, especially in major cities. So without getting our amenitizing correct, that leads to operational efficiencies, I don't think we're delivering a long-term product.
Okay, thanks, Amy.
Yeah.
The particular element of the living sector with probably the most convincing supply-demand fundamentals of all is later living. Yet it's the most it's the trickiest one. Nada, we were at an event recently, and I made a bit of a joke that everybody is looking at later living, but not many people are actually doing anything. Why do you think it's been such a tricky sector to navigate up until now, particularly on the rental side?
Yeah, God, it's got all the challenges of any other living product, plus I mean the planning that's challenging, but there's also people don't necessarily need to move into a later living product home, right? Later living is sort of service. It is sort of serviced accommodation. We've got someone on staff 24 hours if you need, if you got an emergency, but you haven't. It's non-care, right? So if you're like retired and you're living in your home and you're very comfortable and you've got all your stuff, and your kids and your grandkids come over to visit, and your mortgage is paid off. It's quite a big leap to then move into a later living sort of product, and that just means that the sale on to sales or even lettings, really, the time it takes and the marketing it takes to get someone to convince them to move into a later living home is very, very long. So when we look at, say, PBSA, it's very easy to go, well, as long as we finish it by May, it'll be occupied by September. With BTR, similarly, as long as it's a population in a location where there's like a waiting list, you probably get it all occupied up within 3 months. But when it comes to later living, you're talking, I think when we spoke about it previously, you're seeing developers taking like a year, 2 years to get people to decide to convert into, and that's very difficult to convince investors to say, yeah, you could in a competing market where they've got capital and they've got all these options as to where they're going to invest their money. It pushes itself quite low down the queue. In terms of risk and return. Unfortunately, in terms of the housing crisis here in the UK, it would be fantastic if we could convince people to, create that product, convince people to downsize, and it would, these massive homes would suddenly become available for the younger families coming up who need the space. The theory is fantastic, but the reality is the competition is on investor return is just is just too good. So it takes a real strong stomach to convince investors to invest in later living. Those that are coming in, I think, are coming in from overseas and jurisdictions where it's quite well established. They know that it's a long-term play, and I think they're going to come against the what we've discussed before, which is the mindset shift from people who've owned their homes for their entire life, convincing them to rent and going back to that anxiety of living in a rented home. And living in rented accommodation comes with its own anxieties of like, could they kick me out? Can I afford the rent? Can I fit in all my stuff? How much stuff am I going to have to get rid of? All that stuff. People might just say it's just too hard. I'm not going to do it. So it's tricky.
Daniel, you clearly have got a strong stomach, because you said that this is a market that you are actively interested in exploring. So, what are the attractions to it for you, and what do you think would be the challenges of getting involved in that market?
Well, look, I think there's no question it's a market to look at, but you do need a strong stomach, and I agree with everything that Nada is saying, because there's no question in an aging population, there has to be an opportunity around providing living product for aging population. And fundamentally, if you've got a housing crisis, as Nada said, people moving out of their home they've lived in, and then moving into a flat is clearly a way to free up houses for those younger in the population and moving people into the other places. But the problem is I don't really think there's the right product around at the moment. I think when you look at this, because it is so heavily amenitized, you actually only appeal the products that are around, particularly in London, where I am, and I live in North London. They're extremely expensive, right? They're extremely expensive to buy. My father, a real story. My mother deciding should they move out of their home, their 4-bedroom home, should they move to an ordinary flat? And I was saying to them, why don't you look at one of these products? Because it's quite nice. You've got a gym, you've got a pool, you've got services. And when they looked at them, the price comparison just didn't match up, right? Because actually, it's not really what I would call a normal, and affordables, again, a relative statement. But if you've got a house, you suddenly find that these flats are 50% more than the value of your house. So therefore, if you're trying to retire and reduce costs, there isn't the affordable product in that market yet. And I think that's the problem, right? And so it's very, very hard for someone who's making a rational decision of stay in my current house, move to an ordinary flat, or move to one of these products, unless they really are relatively wealthy and want to pay up for those amenities and value them, then it's a very different product. Then they're in a different challenge. But I did speak to someone who said, do you know who's generally in those products at the moment? It's people that don't have children that live in the country, because they actually don't have that person at the end of the phone to come round because they need them to do something for them. And if that's who's generally filling up those products at the moment, that's quite a small market, right? So I think there is a massive, massive opportunity over the next 10 to 20 years. But what's on offer today, I don't think is appealing. It has a mass appeal. I think it needs to be much, much more affordable. But how do you make a product more affordable without compromising on 3 things: quality, location, and amenities, right? So that's, I think, the challenge that needs to be solved.
Thanks, Daniel. Ami, did you want to come in on that point?
Yeah, sorry, I just wanted to ask a question actually to panelists who are really familiar with this area as to what's the policy reform would you really think would unlock this area? This is something that we've been thinking about for a while, and there are other countries which actually have very, very focused policy on later living, both for moving out into more suitable accommodation for later living, whether it's for sale or it's rental. It's just fascinating to see. And do you think, for example, the pension reform that we're seeing right now, would that have any impact in this sector?
My thoughts are that the amount of money that this government is spending on housing people in temporary accommodation, if you reallocated that and directed it in some fashion to incentivize, those in oversized homes to downsize into, say, a retirement living product, that wouldn't that would be an intelligent tactic, right? But what that incentivization would need to look like, I'm not sure. I think the other challenge is, you know, and this is not specific to retirement, but certainly on the planning side, really having sort of a nationwide or, you know, regional wide strategy to actually require towns to build in some retirement living capacity, because the land costs are on retirement are just as they are in everything else, but the actual cost of investing in it, building it, you know, because you compound, it's a compounded cost, right? Because you've got a normal sort of PRS product plus the amenities, whereas in sort of a BTR or co-living product, you sort of got smaller unit size and amenities, and that sort of balances it out. But in the retirement living, you can't really compromise on one for the other. You've got to provide both. So that's completely slicing into your margin and your profit. And so that margin has got to be padded from some other way. So your options are, you know, land, grants, incentives. I know there's sort of like deferred management fees to try and help buyers come in, and you know, and assure them that that's going to roll forward. But that doesn't seem to be moving the needle at all. But yeah, there's huge undersupply and definitely opportunity. But those are my thoughts.
I think that the traditional IRC model is fairly low density. It has a lot of green space around it and this kind of stuff. And I guess one solution would be a higher density, slightly less amenitized in terms of communal spaces and open spaces. That might be one way to go. It's nearly 12 o'clock, guys, and we've only got about halfway through our agenda, which is a good thing and a bad thing. We might have to relive this conversation. I just wanted to finish by asking Ami one last question, and it's quite a complex one, so I'm afraid I'm going to put you on the spot and ask you to give a very concise answer. But what role does ESG strategy play in investment and lending decisions in the sector?
I think it plays a larger and larger role, George, to put it, you know, in one kind of bullet point, if you like. We're entering a time and a period where climate transition and climate adaptation risks are just mounting so quickly that we are seeing insurability of long-term holds really being questioned. We're doing scenario analysis much more often than we've ever done in terms of environmental performance of our buildings. And it's become, in Europe, for example, we're highly regulated now already for that. We're having to produce data on a very regular basis to account for you know, what we've done, how sustainable it is, and, you know, quantifying what the liability is essentially at the end of the life of the building. So I think essentially, I haven't met an investor in the last 3 years who's come and said ESG doesn't matter. But in the last year or so, I've only met investors who've said that ESG does matter, and it matters quite substantially. To the extent that now green finance has become a real opportunity. And players like us who've been at this for a really long time, who've mastered how to do it in an you know, design and sort of operationally efficient way, are going to be ahead of the pack. I mean, I'm pretty pleased about that, but I think everybody really needs to get on this bandwagon, because it's not something, it's here now, and especially the E is really, really critical. I mean, S is of course as important, but E is what really, really makes the difference for now.
Great stuff. Thank you, Ami. Right, we're going to wrap up now. I'm just going to show a few slides, and then we'll leave the session open for a couple of minutes at the end, so you can take some notes from all the good stuff that's in the chat, including the LinkedIn profiles for our speakers. So if you want to carry on the conversation with them, then do get in touch with them via
George,
LinkedIn.
I think there was just one question in the chat, which I think we could answer quite quickly, about COVID and living in proximity to work.
Yes. Do you want to take that one quickly then, Nana?
Yeah, it was just to say that I think that with hybrid working and people working from home so much more, I think there is a very much a blurring between work and home, and I think people like to have an office space to go to, and it's really more about having a designated space. I think that the market has moved, and I think people would rather commute less and be closer to work, and so I think that the tide has changed on that, and it's not really about having separation in terms of distance to travel, but it's more about having a spatial separation. So living and working in proximity is probably a good thing nowadays compared to pre-COVID.
As an ex 5-day-a-week commuter from Hampshire to London. I absolutely agree with you. Yep, no doubt about it. Okay, thanks, Nada. So our next Urban Living webinar will be the last one of the year, and it is looking ahead to 2025, and we'll look at some of the trends that we think are going to dominate the headlines in real estate and hospitality. And if you'd like to register for that, you can see the link in the chat. A quick plug for one of our events, my favorite event that we do actually. It's called Recharge. It moves around to a different European city every year, and we're going to be in Porto for 2025 towards the end of January. It's a really interesting event. It's 80 to 100 people, a high quality audience, focusing on the evolution of the urban development sphere and hospitality. Again, you can find out more about that in the chat. If you'd like to work with us at IHM on our digital offer or our in-person events, then do get in touch with my colleague Piers, whose details you can see on the screen and also in the chat. And finally, I just want to say thank you. Thanks to Ami, to Daniel, to Nada and Richard for their great insights today. Thanks to you all for watching. Enjoy your weekend, and I hope to see you all on another webinar soon. Thanks very much, everyone. Bye-bye.